you were an investor and you looked at what happened in the first half of the year, what happened to your retirement, what happened to your investments, it's a pretty depressing picture. Not only have you lost a significant amount of money on your equities, but your bonds that are supposed to be your risk mitigators, they also got hit really hard. So you've had massive problems of returns, significantly negative. Your correlations, your risk mitigation did not work at all. And it's been a pretty volatile. So it's understandable that when people looked at their first half statements, they got quite upset. So I look at the components of headline inflation, and in particular, what's been driving it higher in recent times. And what we have right now is energy and food in particular are going to be much weaker drivers of inflation. So the headline number is going to come down, but worrisomely, the core number is going to stay stubbornly high. And that just speaks to an inflation process that has become more entrenched and has become more broad-based in our economy.
Right.
So they started getting it wrong 15 months ago when they absolutely embraced the notion of transitory when it was an open question. Had they listened to companies, they would have been much more humble in saying we don't quite understand the inflation dynamics, because companies themselves were warning that the supply disruptions they were seeing, and we know the list, supply chains, container ships, what companies were seeing, what they were warning, saying we're not sure they're going to resolve themselves quickly. And yet the Fed got hooked on this notion it's transitory. And then it got itself into a cognitive trap. It kept on repeating it and repeating it and repeating it all the way, as you know, till the very last day of November, by which time it was clear that inflation was a problem. And then retired it, but didn't move. It could have done more at that stage. And you ended up with this absurd situation that in March, it was still pumping in liquidity. It was still doing QE in March when the inflation rate measuring for February with a month lag was already at a 7% handle. So it is bad analysis, bad forecast, too little, too late, and miscommunication. And that's how we've ended up in this mess. So we have two big dynamics going on. One is on the demand supply. We've gone from a world of deficient aggregate demand to a world of deficient aggregate supply. And you spoke about the elements of that. That's going to resolve itself. But we have another phenomenon going on, which is the nature of globalization is changing. And we are going from a very intense focus on efficiency, on just in time, to another focus on resilience, just in case. And that transition is by its nature inflationary. And that hasn't played out fully yet. That's why it was really important, and it remains really important, to ensure that the inflation dynamics don't develop very deep roots across many, many segments of our economy. Otherwise, we may end up with a low growth, high inflation environment for much longer than we need to.
Why did the market get it so badly wrong?
I think three reasons. One is the mindset. The market has seen the Fed blink before. Fourth quarter of 2018 was an example, but there's been lots of examples of this Fed blinking. Second reason, the message wasn't consistent. It was yes, but. We're going to tighten, but. And then the third is self-reinforcement. That's what we want to hear.
The inflation issue is going to be even more problematic. I think you and I have been warning people, all of you who are looking for a pivot, be careful what you wish for, because this pivot only happens if you have an economic accident or financial accident. And the journey to an economic and financial accident is a very painful journey.